Welcome to The Explainer. Today, we're cutting through all that Wall Street noise to look at the actual mechanics of a choice every investor has to make. Think of this as a quick sit-down with a financially savvy friend who just wants to see you optimize your portfolio. We're going to set a really strong, confident foundation for your financial journey by digging into the nuances of growth versus dividend strategies. Let's get right into it. So to kick things off, I have to ask, what kind of investor are you? Just imagine two people. They start out by investing the exact same amount of capital in the exact same year. Yet decades down the road, they end up with completely different financial lives. Why? Simply because they deploy their money into a completely different type of asset.
Picture this. One of those investors retires early, sipping coffee on the porch, effortlessly collecting checks every 3 months without lifting a finger. It's the dream, right? But the other investor, they watch their equity multiply 5, 10, maybe even 20 times over, but they literally don't see a single dollar of liquidity until the day they finally decide to cash out. Now, neither path is wrong, but if you don't know which portfolio you're actually building, you might just be heading toward a financial destination you never really intended to visit.
Okay, let's dive into this. Starting with the side of the market that definitely grabs the loudest headlines and the most hype, the growth stock engine.
At its absolute core, a growth stock is driven by aggressive, relentless reinvestment. Instead of distributing cash back to you, the shareholder, companies like, say, early Amazon or today's Tesla pour almost everything they earn right back into their own expansion. They are not focused on writing you a dividend check today. Their entire focus is on scaling operations and capturing as much market share as humanly possible.
What's truly interesting here is the mindset driving these companies. They're constantly building new products, hiring top talent, opening up international markets, and just buying up their competitors left and right. The company basically acts like a massive engine, pouring every single ounce of profit right back into the gas tank. And their logic is incredibly simple. Why give you a tiny little dividend today when they can deploy that exact same capital to grow the business and make the stock itself worth exponentially more tomorrow?
And that brings us to capital appreciation. It's a fancy term, but the core engine here is simple. You buy in, the company scales, market demand goes up, and the stock price follows right along with it. Eventually, you sell that equity for a profit. That's the fundamental objective of the growth game.
The upside here is absolutely huge. Growth stocks hold the potential for truly massive returns. We're talking about the kind of exponential growth that can genuinely alter your entire financial future, assuming, of course, you manage to identify and back the right innovator early enough in its journey. But as you probably guessed, that massive upside comes with the volatility factor. Growth stocks can drop, and man, they can drop incredibly fast. If the broader market gets nervous, if interest rates shift, or even if a quarterly earnings report just slightly misses the mark, the price can swing hard. And because these companies pour all their cash into growth, there's no regular dividend check coming in to soften the blow while you just sit there waiting for the stock to recover. So, let's pivot to the exact opposite side of the coin, the dividend income machine. The real question here is, how do we engineer steady, passive income without ever having to sell a single share of what we own? Well, dividend stocks are your firmly established profit sharers. Think of the absolute stalwarts of the economy. Companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. They aren't trying to reinvent the wheel every single year. They've already found their lane, they generate consistent cash flow, and part of the deal is that they pay you a portion of their profits simply for holding their equity. And how often does this actually happen? Usually 4 times a year. That reliable profit sharing is deposited straight into your brokerage account every single quarter. It's honestly the truest form of passive income out there. You just hold the stock and the cash arrives. But there is a strategic mechanic here that even some seasoned investors underutilize, and that's the DRIP, or Dividend Reinvestment Plan. Instead of taking those quarterly cash payouts and spending them, you can actually set up your account to automatically deploy that cash to buy even more shares of the exact same stock. And this brilliantly illustrates the DRIP snowball effect. Step 1, you earn your dividend. Step 2, that cash is automatically routed to buy more shares. Step 3, because you now hold more equity, you earn a larger dividend the very next quarter. It's a highly methodical process at first, sure, but let it compound over a couple of decades, and that steady snowball turns into an absolute financial avalanche.
So the crucial point is, which one should you actually own? Which path aligns with your strategy? Now is the time to shift the focus directly to your personal timeline, your own risk tolerance, and your specific financial goals.
When we break down the core differences side by side, the trade-offs become incredibly clear. With growth strategies, your upside is massive, but so is the volatility, and your income yield is zero. With dividend strategies, the capital appreciation is definitely slower, but the market swings are much tighter, and you secure that steady, reliable income. Trading explosive upside for sleep-at-night stability is a perfectly sound choice. It's really not about which one is universally better. It's about what you need to achieve your specific targets.
This really just comes down to where you are in life right now. Picture a young professional, right? They have decades of time on their side. They can totally afford to ride out the dramatic ups and downs of the growth sector because they don't need to liquidate that capital today. On the other hand, an investor nearing retirement needs predictable income to cover daily bills. They can't afford to check market futures every single day with anxiety. Your time horizon and your cash flow needs completely dictate your ideal path here.
But here is the real secret of successful investors: the blended portfolio. The pros don't just pick one team and stubbornly ignore the other. No way. They blend both. They capture the long-term upside of growth innovators while anchoring their portfolio with the stability and cash flow of dividend payers. They build a financial engine around their actual real life, not someone else's rigid formula.
Ultimately, it all comes down to this core question: are you betting on the future or getting paid for today? Think about your timeline, your personal goals, and honestly, what lets you sleep at night. I hope this explainer has helped you synthesize these core strategies so you can build your portfolio with absolute confidence. Reflect on where you stand, adjust your strategy if you need to, and join us for more insights next time. Keep learning, keep growing, and thanks so much for exploring this with us.